This video is presented to you by CXO Learning Academy, a learning initiative by CXO Math. This is the first video in a series of videos on accounting. The field of accounting is vast and complicated. However, the popular view is that it is boring and mind-numbing. It's assumed to be more of number crunching and auditing. However, accounting can be a very intellectual pursuit with a good amount of debate and issues to resolve. Having said that, let's start at the basics. In this presentation, we will go through the accounting definition and the accounting process in itself. So, who needs accounting? Any individual, corporate entity, partnership concern, joint ventures, etc., or even the government, all of them require accounting in some form. Different institutions have defined accounting differently. But basically, accounting is the action or process of keeping accounts. The Webster Dictionary defines accounting as a system of recording financial transactions, analyzing, verifying, and reporting the results. Simply put, accounting is the language of business. So, what is the purpose of accounts? The purpose of accounts is to provide information, to monitor activities, to provide transparency, and reduce the chance of fraud. Accounting is more than numbers. It is the backbone of operations of a business. If money is involved, there is accounting. In order to manage a business effectively, from the financial perspective, it is always important to measure how many assets does the business own, how much profit is being generated from the capital invested, when and how are the cash flows coming into the business. How is the money being spent? Accounting creates a clear financial image on the basis of which managers, creditors, bankers, and the government take a decision. Accounting can be divided into several areas of activity. The activities we will discuss briefly can overlap and are closely connected to each other. However, it is still useful to distinguish them as accounting professionals tend to gain specialization around these various branches. So, financial accounting is the periodic reporting of a company's financial position and the results of operations to external parties through financial statements. The financial statements include the balance sheet, that's the statement of financial condition, income statement, the profit and loss statement or the P&L, and the statement of cash flow. Hence, financial management focuses on external users. Management accounting. Management accounting emphasizes the preparation and analysis of accounting information within the organization. According to the Institute of Management Accountants, it includes designing and evaluating business processes, budgeting and forecasting, implementing and monitoring internal controls, and analyzing, synthesizing, and aggregating information to help drive economic value. The basic concern of management accounting is cost allocation. Hence, most of management accounting used to be called cost accounting. Auditing. Auditing is the examination and verification of the books of accounts and the business's system of internal control. Auditing is done both internally and externally. External auditors are independent firms that inspect the accounts of an entity and render an opinion on whether its statements present fairly the financial position of the company and the results of operations. The external auditor's primary obligation is to users of financial statements outside the organization. The internal auditor's primary responsibility is to company management. They ensure effective and efficient operations, the reliability and integrity of financial and operational information, safeguarding of assets, and the compliance with laws and regulations and contract. Tax accounting. Tax accounting is based on laws enacted through a highly political legislative process. Tax accountants help entities minimize their tax payments. Within the corporation, they will also assist financial accountants with determining the accounting for income taxes for financial reporting purposes. Fund accounting. Non-profit entities use fund accounting, including government and not-for-profit corporations. Rather than seek to make a profit, governments and non-profits deploy resources to achieve objectives. There are two types of funds generally: general fund and the special purpose fund. The general fund is used for day-to-day operations like paying employees or buying supplies. Special funds are established for specific activities like building a new wing of a hospital, etc. So the last one is forensic accounting. Forensic accounting is the use of accounting in legal matters, including litigation, support, investigation, and dispute resolution. Some of the forensic accounting engagements are bankruptcy, matrimonial divorce, falsification and manipulation of accounts or inventories, and so on and so forth. Forensic accountants investigate and analyze financial evidence, give expert testimony in court, and quantify damages. Bookkeeping. Bookkeeping is the essential part of accounting. Bookkeepers used to manually keep books till the advent of electronic means of entering the transactions. Today, most of the world's businesses use computers for accounting, and some very sophisticated software does the bookkeeping. Bookkeeping involves recording day-to-day financial transactions of a business. The books involved in bookkeeping are journal, general ledger and subsidiary ledger, trial balance, balance sheet, profit and loss statement, and cash flow statements. Moving on to the process of accounting. Identify the transaction from source documents like invoices, receipts, and loan documents, etc. Then we would record the transaction as a journal entry into a journal. An entry generally consists of the date, the name of the account, and debit or credit transactions. Now we post the entry into the individual accounts in a ledger. Traditionally, the accounts have been represented in T accounts, with debit on the left side and credit on the right side. Some examples of accounts are accounts payable, receivables, and property accounts. Consolidate ledger accounts into a trial balance at the end of the reporting period, which could be quarterly, semi-annually, and annually, by netting all the debits and credits in each account to calculate their balances, totaling all the left side, that is the debit balances, and the right side, that is the credit balances. Adjustments like depreciation, amortization should be made at this stage. The two columns should be equal. Finally, the last step is to combine the sums in the various accounts and present them in the financial statements created for both internal and external users. For example, profit and loss account, balance sheet, cash flow statements. Close the books for the current month or the current period by recording the necessary reversing entries to start afresh in the new period. Now that we understand the accounting process, let's talk about the accounting equation. The basic accounting equation is the foundation for the double entry bookkeeping system. The following five accounting elements form the basis of balance sheet and profit and loss accounts. Assets, that is the resource, equals to liability plus owner's equity. Liability plus owner's equity is the claim on resources. Hence, the extended equation also includes the effects of profit and loss account. Hence, asset equals to liabilities plus owner's equity plus income or revenues minus expenses, that's the cost and the dividend. We will discuss the accounting equation in detail in our later videos. Thank you for watching this video. This video is presented to you by CXO Learning Academy, a learning initiative